The economy is flashing warning signs everywhere. Debt is exploding. Jobs are disappearing. Savings are gone. For most of history, this is exactly when markets break. But instead of collapsing, stocks keep climbing, higher, faster, and with no regard for reality. Record highs are celebrated while households quietly fall apart underneath. This isn't optimism, it isn't strength. It's something far more dangerous. The old rules that once forced markets to crash no longer apply. Valuations don't stop prices. Bad news doesn't trigger fear. And the longer this continues, the more people begin to ask an unthinkable question. What if the stock market doesn't crash at all? For decades, market collapses followed a familiar script. Economic stress appeared, earnings cracked, confidence faded, and prices fell. That sequence trained investors to expect pain when fundamentals deteriorated. But that relationship has quietly died. The collapse everyone waited for never arrived. Not because risks disappeared, but because the mechanism that once transmitted risk into prices was replaced. Since 2008, markets stopped responding to weakness the way they used to. Corporate profits no longer need organic growth to rise. Government deficits now exceed $2 trillion per year, injecting liquidity directly into the corporate system. Central banks no longer act as neutral referees. They act as shock absorbers. When stress appears, intervention follows. When intervention follows, prices float. This is why markets no longer fall when conditions worsen. They wait for policy to blink first. Look at the numbers. U.S. total market capitalization now sits around $65 to $66 trillion, while GDP hovers near $30 trillion. That disconnect would have been catastrophic in any previous era. Instead, it's normalized. The S&P 500 trades near valuation multiples once reserved for speculative peaks, yet volatility remains compressed. This is not resilience, it's insulation. The crucial shift is this. Markets no longer price economic reality, they price liquidity expectations. Earnings quality, balance sheet strength, and long-term demand matter less than whether capital keeps flowing. And capital keeps flowing because the system is engineered to prevent contraction. Rate cuts during inflation, fiscal expansion during slowdown, asset purchases disguised through spending programs. Every pathway leads back to liquidity. This explains why repeated crash calls have failed. Analysts waited for fundamentals to break prices, but fundamentals are no longer the trigger. The market doesn't collapse because jobs weaken. It doesn't crash because consumers struggle. It doesn't fall because debt explodes. Those conditions now coexist with rising asset prices because the transmission system is blocked. The collapse didn't arrive because the market wasn't allowed to experience one. The danger isn't that prices stayed high, it's that risk never cleared. Pressure didn't disappear, it accumulated. And systems that suppress failure don't eliminate it, they store it. If the market no longer collapses under stress, the next question is unavoidable. Why didn't extreme valuation stop it? Because the market didn't simply become expensive, it crossed into a regime where valuation no longer functions as a braking system. What once signaled danger has been neutralized. For most of modern financial history, prices were anchored to earnings, cash flow, and economic output. When those anchors stretched too far, gravity took over. That relationship has broken. The clearest evidence is the market cap to GDP ratio, often called the Buffett indicator. For decades, anything near 80% suggested fair value. 100% marked overvaluation. Before the dot-com collapse, the market peaked near 115% and then imploded. Today, that same ratio sits around 220%, more than double the historic danger zone. Yet, instead of panic, capital continues to flow in. The same pattern appears in earnings multiples. The S&P 500 once traded near 15 to 16 times earnings. That was the norm across generations. Today, the index trades closer to 25 to 28 times, even as growth slows. Individual megacap stocks push far beyond that. Price levels that would have been considered mathematically absurd in prior cycles. Investors are paying decades of future profits up front, not because the math works, but because alternatives don't. This is the key link from the prior breakdown. When markets stopped responding to economic stress, valuation stopped serving its historical role. Prices are no longer negotiated between value and risk. They are set by excess capital searching for shelter. In an environment where cash loses purchasing power every year, overpaying becomes rational. Expensive assets are safer than depreciating money. That shift rewired investor behavior. Valuations didn't rise because optimism exploded. They rose because capital had nowhere else to go. Selling stopped making sense. Waiting stopped being rewarded. Even caution became a liability. Once inflation and liquidity dominate price discovery, valuation becomes a reference point, not a constraint. This doesn't mean numbers don't matter, it means they matter differently. High valuations no longer trigger crashes, they signal dependency. The higher prices stretch beyond fundamentals, the more the system relies on continuous liquidity to survive. When valuation stops acting as a ceiling, something else must take its place. That force is liquidity, not productivity, not efficiency, not real growth. Liquidity has become the primary pricing mechanism of the modern market, and it explains why prices keep rising even when fundamentals stall. Since 2008, the system has been rewired to suppress downside risk. Whenever economic momentum weakens, capital doesn't retreat, it's injected. Government deficits now exceed $2 trillion per year, and that spending doesn't vanish into thin air. It moves through contractors, corporations, payrolls, and financial markets. Earnings don't need to grow organically when revenue is being backstopped by fiscal flow. This is how weakness gets converted into stability. At the same time, monetary policy stopped functioning as a brake. Interest rates were lifted aggressively, but the moment financial stress appeared, the direction reversed. Since late 2024, rate cuts returned while inflation remained elevated. That combination matters. Lower rates don't stimulate productivity in a saturated economy. They inflate asset prices. Every cut increases the present value of future cash flows, regardless of whether those cash flows ever materialize. This is the mechanism that replaced fundamentals. Stocks are no longer priced on what companies earn today, but on what liquidity makes possible tomorrow. When the cost of capital falls and government spending rises, prices adjust upward automatically. It's not optimism, it's math. Trillions of dollars searching for yield will always overpower slowing growth. Inflation completes the loop. With purchasing power eroding at 3 to 4% annually, holding cash becomes a guaranteed loss. That forces capital into anything that appears scarce or liquid. Stocks absorb that pressure because they're accessible, scalable, and instantly tradable. Liquidity doesn't ask whether valuations are justified, it only asks where it can survive. This links directly back to why overvaluation no longer stops markets. Valuations fail because liquidity doesn't negotiate, it floods. As long as deficits expand, rates are managed downward, and inflation remains unresolved, the flow continues. Prices don't reflect strength, they reflect volume. The danger isn't that this engine exists, it's that markets now depend on it. When fundamentals disappear, liquidity becomes life support. And systems on life support don't collapse from bad earnings. They collapse when the flow itself is interrupted. Once liquidity became the market's life support, inflation stopped being an accident and started functioning as a stabilizer. What most people experience as rising prices is the same force quietly keeping asset markets afloat. Inflation isn't a policy failure in the system. It's a pressure valve. At its core, inflation reshapes behavior. When money loses purchasing power year after year, holding cash becomes a guaranteed loss. At 3 to 4% annual inflation, a dollar quietly decays without any market crash at all. That decay forces capital to move. Not because investors are optimistic, but because standing still is punished. Inflation doesn't ask people to take risk, it coerces them. This is where the connection to liquidity becomes unavoidable. Government spending injects money, rate cuts lower resistance, and inflation ensures that money cannot sit idle. The result is a one-way channel, pushing capital into assets. Stocks rise not because companies are thriving, but because cash is deteriorating faster than most alternatives. Asset inflation replaces real growth as the primary source of returns. The distortion shows up clearly in corporate earnings. Revenue rises as prices rise, even when unit demand stagnates. Earnings look stronger, margins appear resilient, and markets respond as if growth has returned. In reality, much of that growth is inflation passing through income statements. Consumers pay more, companies report more, and stock prices validate the illusion. This is why record profits can coexist with falling living standards. Inflation also quietly restructures risk. Debt becomes cheaper in real terms while assets appreciate. That asymmetry rewards leverage and penalizes caution. Institutions that borrow to acquire assets benefit twice, once from rising prices and again from debt erosion. This reinforces upward pressure on markets without requiring productivity, innovation, or wage growth to improve. The scale matters. Since 2020, trillions of dollars have been added to the system, while real output has grown far more slowly. That imbalance has to express itself somewhere. Inflation channels it into assets because assets can absorb unlimited price expansion. Wages cannot. Savings cannot. But markets can. This explains why inflation persists even as officials claim progress. Stability is the goal, not price relief. Inflation keeps liquidity moving, supports earnings optics, and sustains asset values. Remove it, and the entire structure loses momentum. What looks like dysfunction is actually alignment. Inflation binds liquidity to markets and markets to policy. And once inflation becomes structural, the question is no longer whether prices are too high. It's what happens if the force pushing them up ever weakens. Inflation and liquidity explain how prices rise, but ownership explains why the system is allowed to work this way. Markets don't exist to reflect the condition of the average household. They exist to preserve the value of capital. And capital is highly concentrated. Roughly 10% of Americans control close to 90% of all U.S. equities. That single fact reshapes every policy outcome. When markets rise, wealth concentrates further. When markets fall, political pressure intensifies. A broad crash doesn't punish the market. It punishes the asset-owning class that underwrites the system. That is why instability is managed, delayed, and diluted rather than allowed to reset. This ownership structure links directly to inflation's role. Rising prices harm wages and savings, but they protect assets. For those holding stocks, inflation isn't a crisis, it's insulation. Asset prices rise faster than costs and real wealth is preserved. The burden shifts downward while balance sheets remain intact at the top. This asymmetry isn't hidden, it's structural. Policy incentives follow ownership. Governments can tolerate affordability crises, shrinking purchasing power, and rising consumer debt far longer than they can tolerate asset deflation. A falling market threatens retirement systems, pension funds, sovereign credibility, and tax revenues tied to capital gains. A struggling consumer does not. That's why interventions arrive quickly for markets and slowly, or never, for households. Leverage deepens the divide. Institutions borrow at scale to acquire assets, knowing inflation will erode the real value of their debt. This magnifies gains on the way up and shifts losses onto the system if prices fall. It's not reckless. It's rational behavior inside an inflationary, liquidity-driven framework. Risk is socialized. Upside is private. This concentration also explains market resilience during economic stress. Selling pressure remains limited because the largest holders don't need to sell. Their expenses are covered, their borrowing capacity intact, and their time horizon infinite. Markets don't crash when the majority struggles, they crash when the owners panic. And right now, ownership is protected. That reality connects everything so far. Liquidity keeps prices elevated. Inflation forces capital into assets. Ownership ensures policy alignment. Together, they form a closed loop that resists collapse. The question isn't whether this structure is fair. The question is how long it can hold before the mechanisms that sustain it begin to conflict with one another. Ownership explains who benefits from rising markets. Passive money explains why selling pressure no longer behaves normally. Together, they permanently altered how markets move, and why downturns now fail to develop the way people expect. Over the past 2 decades, trillions of dollars have been redirected into passive investment systems. Index funds, target date funds, and retirement plans now dominate flows. In the US alone, over $13 trillion sits in passive equity strategies, compared to barely $2 trillion at the start of the 2000s. That shift matters because passive money doesn't evaluate value, risk, or timing. It buys mechanically. Automatic enrollment turned investing into a default setting. Millions of workers now funnel a portion of every paycheck into markets regardless of price, earnings, or economic conditions. Selling is no longer an active decision. It requires friction. Contributions happen during booms, slowdowns, layoffs, and recessions alike. That creates constant demand even when confidence weakens. This links directly to why ownership concentration holds. The largest holders don't trade frequently, and passive inflows reinforce their positions. Index construction forces capital into the biggest companies first, concentrating flows into the same names repeatedly. When megacaps rise, they receive more money by design. This feedback loop inflates prices without requiring broader participation or belief. Liquidity and inflation amplify the effect. As cash loses value, passive systems absorb it automatically. The market no longer needs enthusiasm to rise, only continued participation. And participation is now embedded in payroll systems, retirement rules, and institutional mandates. This is why bad news stopped triggering exits. There is no everyone's selling moment when most investors aren't actively choosing to buy or sell at all. Volatility hasn't disappeared. It's been compressed. Declines are shallow, sharp, and often reversed quickly because inflows never stop. Traditional corrections relied on discretionary selling pressure. That pressure has been structurally removed. This doesn't mean markets are safer, it means they're more rigid. When prices are supported by automation rather than conviction, resilience comes from flow, not strength. And systems driven by flow don't unwind gradually. That sets the stage for the next risk, not overvaluation, not ownership, not inflation, but what happens when passive demand finally collides with a force strong enough to interrupt it. Passive money explains why prices rise without conviction. What it doesn't explain is why almost no one feels euphoric. That absence is precisely what makes this phase more dangerous than anything before it. Classic bubbles were loud. This one is quiet. Traditional bubbles are powered by belief. Speculation spreads, optimism explodes, and risk is celebrated. When they break, psychology flips violently. Today's market doesn't run on excitement. It runs on resignation. Investors aren't convinced prices make sense. They participate because opting out feels worse. That emotional shift changes everything. Look at behavior, not headlines. Retail enthusiasm is muted. Sentiment surveys remain fragile. Consumer confidence struggles near recessionary levels even as indices print new highs. In prior bubbles, confidence peaked alongside prices. Now confidence lags while markets climb. That divergence signals something new. Prices are being lifted mechanically, not emotionally. This connects directly to liquidity and passive flow. When capital is forced into markets by inflation, defaults, and automation, belief becomes optional. Investors don't need to think stocks are cheap. They only need to believe cash is worse. That lowers the psychological temperature while keeping pressure upward. The result is a market that inflates without mania. AI intensifies this distortion. Hundreds of billions of dollars are being deployed into a narrow group of companies based on future potential rather than present returns. In 2025 alone, AI-related capital spending exceeded $300 billion, yet profitability remains concentrated in only a few firms. This isn't exuberance. It's concentration risk disguised as innovation. The danger lies in how this ends. Emotional bubbles pop when belief collapses. Structural bubbles fail when support systems conflict. A market driven by numb participation doesn't unwind through panic. It snaps when one of its pillars breaks. Liquidity withdrawal, income shock, policy reversal. Confidence doesn't erode gradually, it disappears. This is why comparisons to .com miss the point. That era was powered by optimism. This one is powered by constraint. Investors aren't dreaming of upside, they're defending against decay. When bubbles feel uncomfortable, people leave early. When they feel inevitable, people stay too long. This market doesn't feel euphoric because it isn't offering hope. It's offering survival. And bubbles built on survival last longer than anyone expects, right up until they don't. What keeps this market standing is no longer strength. It's confidence, thin, conditional, and concentrated into just a few remaining supports. Strip those away, and the structure doesn't bend. It fails. The first support is consumer spending, which now carries nearly 70% of US GDP. On the surface, spending still looks resilient. Credit card swipe. Buy now, pay later fills gaps. Services remain active. But this is not demand powered by income. It's demand powered by exhaustion. Household debt has pushed past $18 trillion. Savings rates hover near historic lows, and delinquency rates are quietly rising. Spending hasn't disappeared. It's been pulled forward. Confidence holds as long as consumers can pretend tomorrow will cover today. Once that illusion breaks, the largest engine of the economy stalls instantly. That connects directly to the second support, the labor market narrative. Employment statistics still suggest stability, but momentum has collapsed underneath. Hiring has slowed dramatically. Layoffs have become constant rather than cyclical. Wage growth, once adjusted for inflation, is flat or negative. The danger isn't mass unemployment, it's income fragility. A workforce living paycheck to paycheck doesn't need job losses to break confidence, it only needs fear. When workers stop believing their income is secure, spending contracts fast, not gradually. The third support is monetary signaling. Since late 2024, interest rate cuts returned while inflation remained elevated. This was interpreted as reassurance. Markets heard protection. Asset prices responded accordingly, but this is a fragile illusion. Rate cuts during inflation don't restore stability. They trade future purchasing power for present calm. Every cut reinforces the belief that markets will be defended at all costs. That belief itself is now priced in. These three supports, debt-fueled consumption, fragile employment confidence, and policy reassurance, are not independent. They reinforce one another. Consumer spending depends on job security. Job security depends on economic momentum. Economic momentum depends on asset stability. Asset stability depends on policy. Break one, and pressure transfers instantly to the others. This is where the idea of a modern crash must be redefined. Markets no longer unwind because prices get too high. They unwind when confidence loses synchronization. The failure doesn't start with selling, it starts with hesitation. A missed payroll cycle, a failed debt rollover, a funding shock, a policy signal that arrives late or contradicts expectations. The anatomy of the next crash will not resemble the past. There will be no long deterioration, no slow recognition, no drawn-out decline. Passive systems delay selling until thresholds are crossed. Liquidity-driven markets remain calm until they suddenly aren't. When flow dominates pricing, reversals are violent. The sequence is always the same. First, bad news is ignored, then it's normalized. Finally, it's reclassified as systemic. At that moment, liquidity vanishes, not gradually, instantly. Bid-ask spreads widen, correlations spike. Assets that never fell together suddenly move as one. This isn't panic, it's repricing under constraint. Importantly, crashes in this environment are faster, not deeper. They don't require economic collapse, they require a confidence mismatch. When participants realize protection is conditional, not guaranteed, positioning changes all at once. That's why modern crashes arrive without warning and recover unevenly. The system snaps, stabilizes, then resumes, often with more concentration than before. This is the final contradiction. The very mechanisms designed to prevent collapse increase the speed and severity of disruption when it finally occurs. Liquidity suppresses volatility until it amplifies it. Passive flows mute fear until they accelerate exits. Policy reassurance delays adjustment until credibility is questioned. The market hasn't crashed because confidence hasn't been forced to choose. It will crash when it does. Not because prices are high, not because earnings fail, but because the system runs out of room to pretend everything is still under control.